Thank you so much for joining our webinar today, and welcome to Penny Insurance. We're very excited to work with you. Some of you guys have been on this on our call last week, and it's really, really good to see you. And then we have a couple of new faces to this process. So thank you for joining us. We're a nationwide life insurance company in BGA. And before we get into our topic at hand, which is whole life insurance, I do want to talk about what makes Penny different. So like I said, we are a nationwide life insurance and annuity BGA. And I think what makes us really interesting is that we give our agents high compensation, unique products, and a lot of really cool technology. If you are a life insurance agent, you get quoters and you get IGO. If you're an annuity agent, you're going to get Firelight pretty soon here. We have an app fulfillment team that'll handle your applications as soon as you're ready to submit them, so salespeople can focus on selling more. We have a case management team, a policy delivery team, and it's all at no cost. And we also have a best-in-class underwriting and illustration support team. So if you are somebody who wants to have help with your back office operations at almost no cost, Penny is a great company for you to work with. I also wanted to show you guys the fact that we have a white paper that we just built. I'm pulling it up right here, and you guys can access if you scan this QR code and fill out the form. And the white paper is really, really interesting because it is something that explains to you what circumstances you write what product line for. So if you're a producer and you have a person who is afraid of volatility and wants some of their cash value to grow, do you write an IUL or do you write a whole life policy? If you want somebody to have guaranteed coverage for life, what do you write? What about if somebody wants to protect their mortgage? What do you write? If you scan this QR code and fill out the form, you are going to get a message in the email which will show you what to do. And obviously our topic at hand today is whole life. And I'm really, really excited to teach you guys more about this because it is great in this environment that we're in right now. So with nothing further ado, I want to introduce Matthew Gartner, who is on our team and who is a whole life expert. Passing the mic over to you, Matthew.
Thank you very much, Sean. Once again, my name is Matthew Gantner. I am a brokerage manager here at Penny. I have recently joined the Penny team, but I have come from a whole life background working with one of the carriers that Penny does use in MassMutual. But with saying that, I do want to say that Penny as an organization is carrier agnostic. So we are working with multiple carriers for multiple solutions to try to find what's best for you and your client. And with that stated, I will get started in talking about whole life. Give me 1 second here. And I just want to confirm that I am presenting correctly.
Yep, I can see everything on your screen. However, I can see the viewer notes as well.
Okay, give me 1 second to change that then. We will do this.
Perfect.
Okay, thank you. So we're going to talk about whole life insurance here today, and particularly we're going to talk about different ways and that you can use it, sell it, but also some of the basics around whole life. We're going to start off with just the basic definition. Provides coverage through the life of the insured, has tax-free death benefit, and a saving component in which cash value may accumulate. So really, this is not much different than what you might think of for other insurances, but there really are some features of whole life that kind of stand it out against other insurance products. 1 second here. So we're going to go through some whole life basics, particularly guarantees, participating versus non-participating, some advanced features, some sales concepts, and we're going to end with a couple case studies. So whole life, one of the basic building blocks of whole life is the guarantees that it offers. First off, it's going to be guaranteed premium. You never have to worry if there's enough premium for the policy to stay in force, meaning that if you sign a client up and it's $1,000 a year premium, it's the same $1,000 a year now, 10 years from now, however long the premium duration is. Unlike some other products where you may have to figure out, due to policy performance, is there enough premium to keep the policy in force? The premium is going to stay the same throughout the entire contract. And with that, also premium duration. So the length set at the start of the contract is the length of the contract. Meaning if you have a 10 pay, if you're paying to age 65, you're paying to 100, that is the premium duration. So you are going to have that same duration for that same set premium, and these are all guaranteed as part of the contract. So once again, if you're set to pay for 15 years, there's no worry about, do I have to make a payment in year 16 or 17 due to product performance? The actual product itself is built around this guarantee. And with that comes a guaranteed death benefit. Now, this death benefit will never go down as a result of policy performance. So what you get locked in at issue is going to be the guaranteed minimum death benefit that you're going to have for that policy. And then something else that's unique about whole life is there's guaranteed cash value increase that is set in the contract, and most contracts are set to endow to age 100. Now, there
Hey,
will
Matt,
be a little difference. Yes.
Sorry to disappoint. The way that you're sharing your screen, I think, is giving people the ability to toggle, but we're not seeing what's actually on your screen. Can you try resharing?
Sure can. Sorry about the minor technical difficulties.
Yeah, all good. It was kind of stuck at that first screen, but I'm able to, I think we're all able to like go forward, but if you try dropping down the share. Okay.
Let's just go back through.
Now
we should be on the guarantee slides. Okay.
Yeah.
Sorry about that. I'm not sure what was going on with that, but basically I was speaking what was on the slide, so you didn't miss much in terms of what was being presented, so I do apologize for that. So we talked about cash value, and like I said, it is set to endow at age 100, which is where the policy death benefit, the cash value will equal that death benefit. And I will make a note that whole life premiums represented 36% of the total life insurance market in 2024, according to LIMRA. So it is the highest selling product by way of premium in the marketplace. So that begs the question, if you're not selling whole life, someone else down the street will be selling it to your clients. It is a product that is being sold, in various ways, and it is something that should be part of your insurance toolbox. Give me 1 second here. Okay. So there's two types of whole life, non-participating, and this basically means you don't own a stake in the company, no bonuses are paid out. It does typically have less expensive premiums than participating or par whole life, but has overall less cash growth. And then you also have participating. So this is ownership in the company. The participating whole life companies are mutual companies. So when you get a whole life policy with them, you become a member of the mutual. And with that, you have the ability to share profits from the company in form of dividends. These are typically a little more expensive than non-participating whole life, but they do have overall greater cash value growth, which is what you're getting for being an owner within that company and sharing with those benefits. So we're going to go through a couple quick examples. Now, don't feel you have to memorize the numbers on the screen. I will recap them in a couple slides. But all these examples are going to be for male, 55, standing on tobacco, 250K of death benefit, and a pay to 100 type product. You notice for this non-participating product, the premium is going to be just shy of $6,000. You're going to get a death benefit of the $25,000. And you're going to have a cash value within the policy of around $74,000 at age 70. And this is a guaranteed cash value. Like I said, this is regardless of markets, of bonuses, or whatever. As part of the contract, this will be the cash value available in that policy at this point. So then, by contrast, for the same client, a participating policy, you're going to look and we're going to have around 8,500 of premium. Still the same guaranteed death benefit. The guaranteed cash value in this one is going to be a little higher at 82,000, but you notice there's now a non-guaranteed values column. This is going to be as a result of dividends going back into the policy and compounding on themselves, thus giving you a higher cash value as well as a higher death benefit. And this other example of another participating policy, once again around that 8,900 mark, you're going to have those same increased values on the non-guaranteed side versus a policy that is non-participating, which just has the guaranteed values. So we'll just go through a quick overview. You'll see that there are differences, and what is best for the client is really going to depend on what their needs are. For most people, that they like the guarantees, that little bit extra premium to provide that additional protection and additional upside is normally a good sale for the client because that death benefit does grow as the dividends are put into the policy as well as their cash value. Now, I will make a note that like any type of performance bonus or anything, dividends are not guaranteed. But for the majority of the companies in the participating space, they've been paying dividends for 50 years, 100 years, the life of their company. So dividends are not guaranteed, but these companies have a good history of giving good dividend performance and paying dividends forward to their customers. So just to recap, when you're buying a whole life, what you're really buying is predictable and consistent results. You're getting that coverage for life, and there's not going to be that need for adjustments to the contract. So this is really for your clients that kind of want to have that predictability and consistency. They may have some risk exposure with other assets they have, but they kind of want something as a backbone of their portfolio to be consistent and not have to have any need for market results to dictate performance. For participating whole life, you do share in the company's profits via dividends, and it's a non-correlated asset that provides growth. I like to say that when the market goes up, whole life policies go up, but when the market goes down, guess what? Your whole life policies is still going to go up, once again, assuming that dividends are paid, because it is that non-correlated asset. And the companies that are backing these products are diversified enough that the market does not dictate how they solely provide dividend growth. So you really get that non-correlated asset to kind of be a backbone of an overall portfolio for a client. So with all that said, whole life does have some advanced features. So while it is built on those kind of 3 or 4 guarantees that we kind of talked about at the beginning, guaranteed premium, premium duration, and death benefit, really it does have a product that is flexible. So you do have premium flexibility. You are able to go reduce paid up, which means that at any point in the future of the contract, 10 years, 15 years, you're like, you know what, I don't want to pay for this contract anymore, buy me out. That contract would go reduce paid up. The good news about that is, particularly with a participating whole life, and I will say that for the majority of what we're going to talk about from now on will be for participating whole life policies. You're going to have that continued growth within the policy, even though you kind of reset that cash value and death benefit going reduced paid up. It doesn't mean you're locked out of future growth. You can use dividends to offset your premium payments. Once again, in later years, if you have a premium payment of $500 and you're getting a dividend of $600, you can tell the company, hey, I want to use my dividend to pay my premium. So you still get some growth, but without having to come out of pocket for that premium in the future. You can also use cash value surrenders to pay for a premium. So if 7 or 8 years down the road, you're like, hey, my client can't make this particular payment because of life, but they don't want to fully surrender the policy and go reduce paid up, you're able to take cash value out of the policy to pay for those premiums. And then the last thing around premium flexibility, there are term blends, whether that's adding a term rider for a set amount of years to add additional coverage, for 10 or 15 years, to cover mortgage expenses or anything else that they might have, or a term blend that's for the life of the policy that gets bought up over time, that provides a way to increase the death benefit but lower that premium. Each of our carriers kind of has a different version of a lot of these riders and ways of doing things. So definitely reach out to your brokerage manager, or we can hopefully answer some questions as they come up on these. But these are overall some riders that you're going to have. And then there's also going to be some advanced riders. Guarantee insurability rider. This is going to be like for other products where you're going to guarantee insurability for the client in the future to get additional coverage. Whole life does have LTC riders with a lot of our carriers. Once again, check with your brokerage manager to make sure that the carrier and state do have a corresponding LTC rider that covers your client. There are going to be overfunding riders that are available. We're not going to talk much about these, as most whole life products are priced towards being towards that MEC limit, meaning that any overfunding requires some creative use of kind of term blends and stuff to get the money in there. But just note, whole life as itself, you can't say I want a $1,000 premium and say I'm going to put $100,000 in year one. That policy won't MEC. But there are features to overfund that, with some good strategy that our brokerage managers here would be able to help you design. I do want to note that the more you get away from the core design, the more you affect the guarantees. So if you do use dividends to offset those premiums, if you use cash values to surrender, all those are going to affect kind of what you had on that initial illustration. So do make sure that you do understand that, the guarantees are there of a set and forget it, never do anything with the policy. As you kind of adjust and tune, some of those guarantees and some of those first day illustrations results may change. But once again, it's just something to be aware of. So we're going to quickly look at some cash value comparisons. So we're going to have a client who has $20,000 a year for 10 years that they want to put somewhere. I'm going to show you what non-life insurance at 5% growth every year is going to show, as well as participating whole life to have dividend growth on that non-guaranteed value. With that said, death benefit is a major component of life insurance. So this is insurance first and foremost. So although we are going to look at cash values, there is a death benefit component to this, and that really should be the driving factor of providing the life insurance. Because as you'll see, the insurance kind of lags a little bit versus the other numbers because it has that death benefit built into it, and that's that added feature of buying insurance versus just strictly investing. So here we're going to show just a simple 5% fixed yearly increase, $20,000. You're going to notice that at the end, $264,000. Great return if you can get 5% fixed yearly without having to do any bells and whistles. That's a pretty good return. Now the same thing for 10 years on a 45-year-old male putting $20,000 in. It's going to have around $211,000. So that is going to be $50K less, but you are getting $350,000 of death benefit tied to that cash value. So once again, this goes back to the need for insurance, but you do see that you are losing some, but you're not losing as much you might think to put that money in an insurance contract. And once again, these are early numbers, just like anything else. Both sets, these numbers will compound as the policy grows. So that same client that put in that $20,000 for 10 years, that was a 10-year product, so they only needed 10 years of payments. They're now saying, hey, I want to take out some withdrawals and loans from my policy in later years. So this is going to simulate that client taking out a max withdrawal for 20 years of income. And you're seeing here that they're going to have around $28,000 per year. What I like about this particular slide is you're going to show that the cumulative net outlay, that kind of second column from the left, you're going to see that at the end of the 20 years, they're minus $368,000. That means that they recouped the initial $200,000 that they put into the policy and gained another $368,000 from the policy above and beyond their initial investment. And they still have a death benefit at the end of that year of another $130,000. So this kind of simulates that client that wants to have income every year. So the distribution works just like distributions from a lot of other insurance products. They're going to be tax-free when you surrender up to cost basis and then loans are taken out. The policy can also go loans only, although in my experience, I found that for most designs, going surrender and then taking out loans results in a higher distribution for the client. And then when you're looking at the values, because this is insurance, these values should be compared pre-tax values from other assets. So if you look at that 28,000, if that person is withdrawing 33,000 from a taxable asset and then gets taxed 15%, that would then leave them with that $28,000. So because it's life insurance and you're pulling it out tax-free, the number may be a little lower than what the client's thinking of. But once again, they're getting that without having to pay taxes on top, like they might have to do with other assets. And just as a word of caution, you'd always want to run in force before doing any withdrawals to find out that max amount to keep the policy in force, because the numbers would change based year over year on performance. The illustration is going to assume the same dividends every year for that entire policy life cycle. So we're going to go into quickly some sales concepts. This is probably what most of you are here for. How can I sell this and who am I selling this to? So we're going to talk about generational protection, legacy protection, and income replacement. I will note that for all these are just some of the concepts that we have access to. Really, there's very few insureds that you can come across where whole life may not be an option for them. And the great part about insurance is you don't have to necessarily sell them one product. Sometimes a mix of products is the best for the client. But we're going to go through and talk about each of these in particular. So generational protection, it's a gift they can't outgrow. So if you're talking to a parent or grandparent, you know, they can buy them the latest video game, they can buy them, whatever it is, but they're going to outgrow those types of gifts. A insurance policy is a gift that they're not going to be able to outgrow. And with the flexibility of future withdrawals, that gift that they give them at the start could help pay for college tuition, could help fund a wedding, be a house down payment, or be the seed money for a business startup. And what you're providing to these customers is an all-in-one service. You're really talking to customer and talking to the client and saying, you know, I established that insurance is great for you. What about the next generation or the generation after that? Have we thought about the grandkids? Are they fully protected the way that they need to be? You know, we will talk in the generational for the estate on kind of some gifting and stuff, but this is a good way for them to use some of those gifting dollars to kind of have that continue to grow on a tax-free basis. And we do have a lot of clients like yourself that are working with clients in their later ages who are setting up 10 pays or 15 pays for their grandchildren to kind of put the max money in that they can in order to provide that that legacy for those children in the future. And then speaking of legacy, whole life insurance is great for legacy protection, estate planning, leveraging your gift tax exemptions, business succession planning for funding ILETs. A lot of these advanced concepts I would recommend we talk to a brokerage manager on as you have any of your clients that have these particular needs. But whole life and those guarantees behind it really kind of help fit that need of what the client's looking for. Hey, I want to make sure that this money I'm putting in today is going to be there and grow in order to protect my estate that I'm expecting to be XYZ in the future, and not have to worry about, am I going to need to continue to fund this? Is there going to be additional need for monies later on? Is the value not going to be the same? Whole life really kind of helps these types of clients have peace of mind of knowing that the planning that they're doing is going to be the planning that happens when it's time for those assets to pass on. And then what we'll show as some of our case samples is what a lot of clients are going to ask for is going to be income replacement. Now, first off, like I said, this is a non-correlated asset. So that means tax-free withdrawals. It's not going to be tied to the market and performance. and it can be a supplement to other income sources. It doesn't need to replace everything. It can, but it doesn't need to be the sole way that the client has to, fund their retirement. A good thing about whole life insurance, it has no mandatory withdrawals. So unlike an annuity or some other assets that may force a mandatory withdrawal, whole life is there if you need it, and if it doesn't, you pass on that death benefit to the next generation if you end up not needing the value that you've accumulated as a living benefit. So the case study we're going to look at first is by Ernst & Young, or EY as some may know it by. This was an independent study that they did of retirement income and legacy portfolio transition, basically meaning they looked at what a person could get in these different scenarios for both income or passing their portfolio on to the next generation. It shows different types of strategies among different asset classes. But one of the main things is they use participating whole life for its insurance component. And they particularly said that the way that the whole life performs was why that they chose it to be kind of the stake in the ground for being the insurance component of this study. There's a link down there, and we can send that to anyone that would like it for the full study. It is free to read through. I am going to just kind of show some segments of it, but it's an interesting read to kind of show how a overall portfolio with participating whole life in it can help a client. Because a lot of us are going to have clients that are going to say, you know what, I'm going to buy term and invest the rest. If you ever had a client that says that and you're like, okay, what does that actually mean? So if we look at retirement income for this with a buy term, invest the rest, you're going to look at a couple different options. You're going to see what it is for investments only. The bottom three are with a percentage of that portfolio money being spent on term insurance and the rest on investments. And then that middle section, the 10% PLI, that's participating life insurance, that whole life, and then the rest of investments. And you'll notice that for both income and legacy, that those ones with participating whole life and investments kind of gave the most. I kind of highlighted that 30% because it had a good mix of retirement plus legacy. But as you see, as the client needs change, they can do more or less, and depending on what they're putting into different segments of their portfolio will result in kind of how that portfolio performs. But showing that whole life being added to it as opposed to just buying term and investing the rest is going to give them a greater portfolio than just doing investments or the term and investment. So another thing that we often hear is, I'll use annuities for income. Other than what we previously said of annuities require that you do make mandatory withdrawals and you may not want to or need to make those withdrawals versus whole life. I will say that, a deferred income annuity with income inflation protection plus investment does produce some great results for retirement income versus your investment only, and does add some to that legacy at the time horizon for when it's being passed on. We'll kind of segue that into what wouldn't be kind of the best strategy. As we'll see, the term only is kind of off this chart because we've already established that's not kind of the best way, but you will see that some of these figures with both participating whole life with a deferred annuity and then the rest of investments are going to give you highest mix of income at retirement as well as a legacy to pass on. So really this is about finding what's best for your client and kind of figuring out what is it that they're looking for, what needs do they need to be met, and showing that not one product is a problem solver for everything, but that good mix of products as well as whole life can provide that income plus give them a legacy at the end versus just putting in investments versus just putting it into annuities. So you kind of get the best of everything with that mixed strategy. So now we're going to go and talk about a non-correlated example. Once again, this is that same 20K a year for 10 years that we talked about earlier that was showing $28,000 a year over 20 years. But this client's going to use whole life insurance to protect against down years in the market. The EY study showed kind of annuitizing everything and taking out the same withdrawal across all assets. But realistically, a client is going to take from their best performing assets, when they need to, and then leave those to recover when they need. So whole life insurance has a great way to kind of protect against the market. And it gives them a way to kind of have access to cash value in the years that the market goes down. So in this example, we're showing every 4 years, starting at age 66, a withdrawal from the insurance policy. This is to simulate the down year in the market. We can't predict what year will actually be the down year, but as history has shown, the market doesn't go up every year. There are times when the market is down overall. So when the market's down and your portfolio's down and your correlated assets, whole life is great to lean upon and say, hey, you know what? I'm going to take the money out of my whole life contract now and let my market assets recover this year and then maybe take from them next year. And you see with this type of deferred strategy where you're only taking it out when needed, you can actually take out a lot more, and you go up to 105,000, which is around 124-ish of value that they would have to take out of like a stock portfolio to gain that income that you're getting from the tax-free whole life. So this is a great example of showing the diversity of whole life and showing that the down years in the market aren't going to affect whole life in the same way. This policy is still going to grow, they're still going to get performance, and then you can lean on it and tap on it in those years that the market is having those downward effects. Now, we did cover a lot of information, and it was at a very high level. I know I may have gone through it a little fast, but really this is to kind of let everyone know that we're here for you. For me personally, this is something that I used to do every day in my life. For a lot of the other brokerage managers here, they talk about this all the time as well. And really, we're here to answer those questions and kind of dig deeper. So when you have a client that's, thinking about what other options they have, and whole life comes up, or more importantly, you bring whole life up in the conversation, because once again, it's 34% of the market by premium. If you're not, an agent down the street is. When you're bringing it up as an option, we're here to help you go through those plans and kind of design those solutions. But does anyone have any questions as we stand right now?
I have a few questions that
Okay.
I can provide to you.
Sure.
So first one I want to give you is, how are distributions from the cash value treated regarding taxation? I know you answered that in the middle, but if you could just answer it again.
Sure. So it's going to make sure that you take distributions. You can take withdrawals up to the cost basis without any tax implication, and then you're able to loan from the policy for any other distributions, which are going to be also treated tax-free. Because what's going to happen is at the end, when the death benefit is claimed, the loan's going to be paid back from the cash value that was there to pay off the loan, to then give the remaining death benefit to the client or to the beneficiary. So there's no tax implication as long as you're doing withdrawals or loans up to that cost basis. And that's why I said it's important to run that in-force policy, to not say, oh, the client can take out $30,000 this year, we're going to take out $30,000 next year due to dividends or whatever that may be, $30,500 or $29,500 or whatever it is. Reynolds enforced policies, but you are able to take out income from the policy tax-free. You're also able to surrender the full cash value, but with that, there may be tax implications. But for an income strategy, you are able to access the numbers that we showed on a tax-free basis.
Awesome. Another question I got was, people compare whole life policies to IULs all the time. So when does whole life have, or in what circumstances do whole life policies have a definitive advantage over IUL policies?
So that's a great question. I kind of touched upon this a little bit. It's for those clients who want those predictable and consistent results. As we know with an IUL policy, there could be some type of cap change, rates change, you're already tied to the market. Zero is your hero, as they say, but Zero is also not really growing that policy much versus a dividend paying out. So it's for the client that wants a little bit of that protection and that consistent results. I'll be totally transparent. A good performing IUL that is properly managed with a lot of good years early without any negative market years can outperform a whole life policy. But the whole life policy is going to have that kind of safe and steady, that slow and steady to win the race approach. So it's really going to be down to what that client is looking for. And really where I position whole life is as that non-correlated asset as part of their overall portfolio. So there's nothing to say that if a client has $10,000 of money that they've dedicated to insurance, that you couldn't go like 7 and 3, 7,000 into an IUL to have some of that upside, but 3,000 into a whole life to offer that kind of backbone and that consistent result. This is not an all or nothing game. For a lot of clients, especially ones talking, about whole life, you're normally talking about a little larger premium, and having that split sale will make sense because now you're diversifying their assets within their insurance portfolio versus, if you say, hey, I want you to invest everything in ABC company, they're going to be like, no, like I've been told to diversify my assets. Insurance is no different. So I hope that answered the question of kind of where to position it, but it is for a lot of clients that are looking for those predictable returns. And that's a way that if you're looking to position this for clients who are unsure of where to go and not saying, what's this versus an IUL, that's your kind of lead in of like, it's a non-correlated asset and you have these guarantees built in and it's that safe and reliable product that still has that upside. So that's kind of how I used to position it as well.
Yeah, I noticed that when when the market is super volatile, all of a sudden, insurance agents are asking us about whole life, and like you said, it's a sizable chunk of the industry. What I noticed is a lot of agents are also kind of stuck in that term space. I noticed that a lot of I came from a Northwestern Mutual background, so we just started with whole life. And as soon as I went into brokerage, I noticed everybody's selling term. So guys, if you know a guy that is interested in whole life or that you think would be a good fit, please call Matt or somebody at Penny to run you an illustration and help you tell the story. All you need to do is know a guy and bring that person to us, and we could tell you what to do with it. And right now, with this kind of volatility that we're experiencing, it's a really, really good time for you to identify those clients and talk to them. Another question, Matt, that I had was, I have two more, by the way. What would you say are the top 3 like whole life carriers that you might recommend?
So being with Penny and coming from Mass Mutual, of course, I'm going to say Mass Mutual is one of the top carriers I would recommend. Little homage to my former employer. But Penny is carrier agnostic. We work with a lot of major carriers, particularly with participating whole life. We have Assurity, Mutual Trust Life, National Life Group, SBLI, and Security Mutual Life of New York as our participating carriers. So it's really going to come down to what's going to be the best fit for that client out of the entire product range that we have to offer. And that's how I would really position things with the client, is kind of getting that risk analysis of what are they looking for, what are they trying to protect against, what type of insurance that they need, bring that information to us, and then we can identify which carrier among our many carriers kind of fits that need best in order to then provide a solution for that client, as opposed to being like, this carrier is the best all the time, because that's not always the case. I mean, I do have some that I like more than others, but I will look at all of them on any particular sale to kind of understand what's going to be the best. So those are the ones we work with in the participating whole life space. We have more in the non-participating, as well as some final expense and guaranteed issue, which is kind of a different type of whole life. But that's kind of how I would frame that, is what's their risk analysis, and then let's find the product among all the carriers we have that best fits that client's risk analysis, because it may be different client to client.
Awesome. And then I saw a question from Brandon. I think it was more directed to me. I haven't been getting these recorded webinars. How are they sent out? The one last week wasn't sent out. It didn't record, so we had some tech issues, but this one will be sent out via an email to you guys after within the next 24 hours. So apologies for last week. The last question I'll end on, and this is really a preview for one of our sales concept webinars. So we are going to start really looking at situations that can get these types of policies sold for the right client, and really going in deep into them so you guys understand the ins and outs of how to sell to this client type. So the question is, you know, in your slide, Matthew, you mentioned using a whole life policy for things like education, grandparents giving education or weddings and stuff like that. So I would say the question is, how would you sell a whole life policy for college savings as opposed to, or in addition to, a 529?
So I think reading into what you're saying there, I believe we are going to have that particular topic. I believe I'm actually going to discuss that in a month's time or so. In the short term, to not give away the entire presentation, whole life is versatile. 529 is kind of locked into the college savings. So you're getting a lot of the same features and benefits. The one thing I will say is, for a client, you're going to have to look at time horizon as one of the main factors for determining between the two. Because, as you know, an insurance product does need time to kind of build up those values. So if they're looking to fund college 2 years from now, whole life is not going to be the solution. But if they, you know, have a grandkid and they have 10 plus years, that's when you can start looking at, hey, this is an option. And then if the grandchild does decide, hey, I've gotten a full ride, I don't need any of that additional money, or, you know, I'm becoming a rock star, I need to start my own business, like, they have the ability to access those funds in a different way. But we will have a complete presentation on that exact question coming up in the future, as well as some more in-depth ones on these particular things. But if you do have clients in the meantime that are fitting these needs, or you have questions about that, reach out to one of us here at Penny, and we're happy to walk through in more detail on a one-on-one of the client and of the kind of things that you're looking at.
Awesome. Okay, well, with that, that was the last question that we had. This is a really informative and awesome webinar. For those of you guys on this call, make sure you're on our email list, because we're starting to do these trainings almost every week, and we're already seeing great results of people bringing their cases to us, getting those cases in underwriting, and then getting those cases approved and issued out correctly the first time. So if you guys have anybody that you guys think would be a good fit, please call us. Matthew is available for you to call, as well as our other brokerage managers. And we are really, really excited to work with you. So with that, thank you, Matthew, for your time today. And I hope everybody has a great day.
I think I saw one other comment from Linen. What's the optimal range for whole life? And that is from 0 to probably 80 or so. And it's really going to depend on what the client needs, but there's different products for different age ranges. And it's not something that is set of, you have to sell it to only this particular range. The need for the client might change based on their age, but the product is versatile enough to be able to cover all different age ranges with different designs or different, you know, pay periods or funding levels. And I think that is all the questions. Sorry about that. I just wanted to make sure we answered everything.
No, perfect. Awesome. Thank you so much. And thank you guys for the questions. I hope to see you guys again next week. And then we have that white paper coming out that we had earlier tomorrow. I saw that some of you guys downloaded it. So thank you. And we're looking forward to seeing you next week.
Thank you, everybody.